Absolutely. Hi, good afternoon, everyone. Thanks for joining us. My name is Darren Cooper. I am the regional director for the territory and that works with Producers XL and distribution. So it's a pleasure being with you today. Got another gentleman on the phone with us as well, Chris Marcosi. Chris is a regional consultant that works with me in the territory and focuses specifically for our retirement product portfolio, which we'll touch on in just a moment. Before we do that, though, we thought we would put a little bit of information on screen here regarding Global Atlantic from an overview perspective. We get a lot of questions, a lot of information requests. Give us a little bit of an overview before we dive right into the meat of the content here, which is the retirement portfolio, which you're here to hear about mostly today. Global Atlantic is a diversified financial services company located in the United States. We do business in the United States just as you do. That's the only place we operate. We think that provides some alignment, obviously, for the markets that you are in. Specifically, we're top 5 in fixed annuity sales, top 3 from an in-force insurer standpoint on indexed universal life, and then a top 10 provider of pre-need life insurance. We think that's important. It gives us obviously a diversified footing, but it also provides some expertise and some experience and some industry knowledge at the leading edge on each one of these positions in the various portfolio. Global Atlantic, I like to say, is a growth story. You can certainly take a look at that asset chart that is on screen here and look at the asset growth from 2016 to 2020. I like that for this reason. In an industry where we have seen continuances of contraction, less capacity, less carriers in the marketplace, Global Atlantic is certainly not that. Global Atlantic is a growth story where we are aggressively looking to grow our annuity business, looking to grow our life insurance business, and looking to grow our pre-need insurance business. And then we have a reinsurance division as well that focuses and working with competitors and reinsuring blocks of business in each one of those categories, which you'll see press releases from time to time. But that is essentially who we are as a company and the solutions that we offer. A few short months ago, back in 2020, we did announce that we became a part of another organization, KKR. On screen there, you'll see some ratings highlights and essentially responses from the rating agencies after the acquisition by KKR of Global Atlantic. Global Atlantic is a wholly owned subsidiary that sits on the balance sheet of KKR. So really positive comments, really positive rating affirmations, confirmations, as well as outlooks. You can see AM Best as an A there, Standard & Poor's, A-, A at Fitch, and A3 for Moody's, all of which have had a really good view, really positive view from reaffirming the ratings as well as putting stable to positive outlooks on the ratings. So we talk about that. We get a lot of questions, especially after the acquisition and being on the balance sheet of KKR. What's the impact and how do rating agencies view it? There's in a nutshell, right on our insurance overview, kind of a highlight of the response from the financial strength ratings agencies. We're extremely excited about the positioning and the go forward aspect of Global Atlantic and our partnership with KKR. Chris, with the next slide, please. Before we get really in depth into the primary content that you're here to hear about today, with specifically the EDB, thought we'd put up on screen just kind of an overview of the portfolio from Global Atlantic, and what you see there from left across the right, off to the right there, the life products as well as the retirement products. I mentioned we're top 3 in the life insurance space from a block IUL insurer. We actually have 3 different products there. Designed in essentially two different categories, I'll call it. One being an accumulation focus, where you're trying to overfund cases or premium finance cases, or you're selling cases to businesses for key employees where balance sheet transactions, positive numbers on the balance sheet is important. You tend to see the accumulation products, the Lifetime Builder Elite, and the Global Accumulator product being placed there. Then in addition, we have a death benefit focused product which really provides guarantees. That's the Lifetime Foundation Elite product. What I'll say about these three products, there's two in the accumulation category and one in the legacy protection category. These are very competitive, ultra competitive products. From the death benefit product, what that really means is premiums to obtain guarantees. If you're not familiar with that product, I'd highly encourage you to take a look at it. It's an extremely competitive product across the board, whether it be short pays, level pays, medium pays, 10 pays, whatever it happens to be, single pays. It's extremely competitive. And then from an accumulation standpoint, whether it's what you're trying to place on screen there, or maybe a college funding alternative or a supplemental retirement plan, really attractive offering in both of those products that you should be able to see plays very well in the industry on an IUL chassis. As we move over to the retirement portfolio, Chris is going to talk about the accumulation, specifically the EDV. So I'm going to breeze right over to the side of that, and I believe he's even going to mention a little bit on the other two as well. What I'll mention here across the board, whether it be the life insurance products, as we move over to the EDB that has a really compelling story, to the 150 product with strong early income for the positioning of that, and then you can see the healthcare needs, 2 times income. Some really key features that set us apart, we think, from the industry, and then the 4 certain product series, the SPIA series, and specifically the 5 to 10. You can even go longer with that with period certains, where you're looking for immediate income. You should see us, and we're right there in the top tier of immediate income, an extremely competitive product offering. And lastly, I'll say the 4Care product. We held a recent WebEx with, or a Zoom, I should say, with Producers XL last week. And I believe, Scott, we have another one this week or next week, I believe it is. Go ahead,
Tomorrow
Scott.
at 10. Tomorrow at 10 o'clock.
Tomorrow.
He's going to be hosting another one. So, yeah.
Tomorrow at 10. Yeah, it's sneaking up on me, but it is on my calendar. I know that much. We look forward to hearing from you and joining us tomorrow on that one. Certainly is a benefit and a need that is on everyone's mind, especially over the last year with what everyone's gone through, and coming to the recognition that if you weren't already there of, the long-term care benefit and the need for long-term care, and frankly, and that's not going away in the United States. So this product offering provides a really attractive solution for a growing need in the United States. So we look forward to seeing you tomorrow, and specifically to talk about the 4Care product with Producer XL distribution tomorrow. But today is all about the EDB and the choice accumulation. So with that, Scott, I'm going to turn it over to Chris, if that's okay with you.
Absolutely.
Awesome. Thanks so much, Darren. And thanks, everyone, for taking some time here and allowing Global Atlantic to be a part of your day. We understand there's been a lot of Zoom meetings over the past year or so. So really, truly appreciate you taking some time here. And hopefully we'll deliver some great content here. And before I move into the specific products, the main takeaway, if you look at this portfolio, is we're a diversified company from a company standpoint, but also from a product standpoint. I want to discuss that Income 150 Plus in a little more detail. That is one of our flagship products, but we understand that not all cases for income look exactly the same. So use Scott as a resource. You use myself or Darren as a resource. We have other income strategies that I'm not going to get to today that may fit certain cases that you're working on. So again, we just want to ultimately deliver the appropriate and best product for the end customer that we can. And before I dive into the materials here, I want you just to jot down a quick number. I'll get to it later on here in the presentation, but $68 trillion. I'll say that again, that's with a T, $68 trillion. So just jot that down. I'll get to it here in a few moments. But with that, I'm going to dive into the product portfolio, as I mentioned here, starting with our Income 150 SE. This is designed for strong early income. We define early here at Global Atlantic as an income need within the first 5 years. And you'll see why it's strong in those areas. And again, this is a fixed indexed annuity. Here's what you need to know with it. I like to be upfront with the cost. There's a cost like most products for the income rider. But what you get with that is a 20% upfront bonus to your income base. And by upfront, we mean on day one. So the day a policy is issued, it's getting a 20% bonus to the income base. After that, you have years 2 through 5, potentially 4 more guaranteed deferral credits to your income base, those go at 7.5%. So that's why this is designed for early income, for those guaranteed credits, and especially that 20% upfront. Really powerful, tagline and phrase here that I've used a lot with success is, if you wait 1 year to the day, you're getting a 27.5% credit bonus to your income base. So again, you wait 1 year, you get 27.5%. So we see a lot of clients either buying the policy and starting the income after 30 days, or waiting that 1 year to get that 27.5% credit. You can do lifetime income at a single or joint payout. You don't decide that until you go to activate the income. So there is flexibility built in there, because your plans today may not be your plan a year or 2 or 3 from now. And as Darren mentioned on the intro slide, we do have our income enhancement benefit, which I like to call our LTC doubler, that you could potentially double that income payment for up to 5 years if the client does have a healthcare need. Now, this product is not designed for long-term care, but for cases that a client may not get approved for something like our For-Care product, it is a good option to have there. It doesn't come at any extra cost. It comes with the policy there in the event that they do need it. Here's a quick visual of what this looks like, just starting with a $100,000 premium, deposit $100,000, right away, day one, your income bonus, $20,000, your income base is $120,000, day one, and then you see those additional 7.5% credits going on for the 5 years. You'll see here, there is the potential for one additional income bonus. Now, I would go into this product with the mindset that you would use it for early income, but if you do have the luxury to wait a little bit longer, if you wait 10 years, there is a potential one additional bonus that factors in your interest credits. You get 150% of whatever your credits are for one more potential deferral bonus there to the income base. But again, we see most cases that not being reached because folks are purchasing this for income in the first 5 years. And then here's just a very quick visual. It's a simple concept. I like to show it for that income enhancement benefit. In this example, we've activated the income. You get your regular income stream for 2 years. The next 5 years, if you can't do 2 out of your 6 daily living activities, you would double that income payment for up to 5 years. And then after that time, you would just revert back to your regular income stream that would then continue for the life of the policyholder and the owner. The only caveat here is this income enhancement. You just need to be 75 or younger to have this included with the policy. But we can issue this up to age 85 without that income enhancement. Here's just a very quick illustration example. In this case, we deposited $200,000. You can see here how I've highlighted deferring 5 years, how the withdrawal base grows, what your regular lifetime annual payment's going to be. And then here's that accelerated income enhanced payment for the LTC doubler. So again, very simple concept, but for guaranteed income, that's probably needed sooner rather than later. The income 150 plus, because of that 20% day one bonus, is very, very strong in the industry. So I'm going to pivot from there to our choice accumulation 2. Now, this is also a fixed index annuity. I call it our base FIA. You can use this really one of 2 different ways. You can buy it for growth and protection and tax deferral, or you can elect to have that very powerful enhanced death benefit, that EDB that you've been hearing about. You can attach that rider to this policy. You don't have to get the EDB, but it is housed on our choice accumulation 2 fixed index annuity. So again, here's the need to know with it. If you don't choose the EDB, so we're not going to get to the EDB just yet, no risk, principal due to market losses. What you put in is the lowest amount you're ever going to see, assuming no withdrawals. There's no cost or fees for the base product. Gross tax deferred, like all annuities. And then I'll get to some of the index-linked crediting strategies, a few that are really powerful and provide that upside potential with that downside market protection. And I'm assuming that most on the call here see the value in a fixed index annuity, but I just always like to go back to this, really for myself, just to reinforce why it makes sense. You lock in those gains. You don't have to worry about down markets here. We've been very fortunate with a bull market here over the past 12, 13. Who knows how long it's going to run, but for the clients that don't have the luxury of time on their side, the ability to lock in those gains, not have to worry about a down market, and also provide some serious growth potential over maybe just a traditional fixed product. Again, I always like showing this as an example of why you might want to consider a fixed index annuity. So with Choice Accumulation 2, we offer about 9 different crediting options. You see them listed out here. Hopefully some of these look familiar. We go as simple as you can do a fixed rate option. You can do an S&P annual point to point. That's very popular in the industry. But as far as Global Atlantic, we see a lot of traction with, if you look to the bottom right here, this 2-year point to point spread. It's based on a Franklin US index. We've seen with that portfolio years of double-digit returns that can really, if you couple that with the inability to lose money with the market and the upside potential that you get on that portfolio, that is one of our more popular strategies. And I a lot of times see it paired with our PIMCO balanced index, because that operates on a 1-year point-to-point participation rate. So you have the 1-year potential with the credit with the PIMCO, and then every 2 years when that Franklin credits. Each portfolio by themselves are very powerful. When you combine them together with the potential to get a credit every year, we see that utilized a lot, something like a 75%, 25% mix, 60-40. There's a lot of customization and optionality that you have here. But again, just a diverse portfolio here with the indices that we offer. And we're committed to renewing those. So they're guaranteed for a year per terms of the contract, but I just like to be upfront and show this. And we've renewed each rate the client signed up for 100% of the time. If the policy is in its surrender charge period, it's either 5, 7, or 10 years, whichever you choose. We've 100% of the time renewed clients at the same rate, spread, cap that they signed up for. That's our, the commitment we aim to make to our policyholders. We want to, allow them to receive, what they got, 3, 4, 5 years ago, and deliver that to them during the length of the surrender term. But again, per the contract, you can only actually guarantee it for 1 year. And that's also why, I think the EDB, that benefit is even more powerful, because that actually is guaranteed. And I'll get to that here in a little bit. This is our full rate sheet. There's a lot of numbers here. I'm not going to go through all of them. It's available on our website through our annuity toolkit. But this just kind of gives you a feel for, where you can go, one-stop shop to look at, what the caps are, the spreads, rates. And if you have questions on any of this, feel free to ask Scott, Darren, or myself, and we can answer any questions that you have on it. All right, so I'm just going to go back to that number that I quoted here when we started, $68 trillion. Over the next 25 years, there's going to be $68 trillion that's passed from one generation to the next. In and of itself, this EDB feature is powerful when you couple it with the huge opportunity set of all those assets that are being transferred from one generation to the next. Is every single dollar a perfect, dollar for the EDB? No, but it is a simple story that gives you more options, and we think a really powerful option to capture some of that because it is a need that that is going to arise for your customers, your clients. Money will be being passed down. So if we identify the right assets and we can put it into something like this, really creates a powerful combination. So with this, like with most of our strategies, it's a very simple story. You really can tell with 3 numbers: 7%, 15 years, cost of 50 basis points. So you pay 50 basis points, you get a 7% guaranteed roll up, simple off your premium that goes for guaranteed 15 years. So this product, the Choice Accumulation, we can write this up to age 85 for the death benefit. You just need to be 75 or younger, so just keep that in mind. As Scott mentioned, really powerful, RMD story. It's a dollar for dollar reduction for RMD withdrawals. And I don't want to gloss over that. That is really important, and we'll see why. There again is that fee, the 50 basis points that's assessed at the end of each contract year. And then just a quick example there on the box on the right, $100,000, $7,000 a year for 15 years. So you more than double your legacy assets over that time period if you choose to elect that optional enhanced death benefit feature. Very, very simple story. And I do want to take a second here, because you may be tired of hearing my voice, so I do want to share with you a really cool client-approved video that walks through this, that again, you can obviously watch yourself to educate, but you can also send it to clients. We designed this to be client-approved, so I'm going to share that here for everyone to enjoy.
If you're looking for opportunities to protect and grow the money you plan to leave your beneficiaries, take a closer look at Choice Accumulation Fixed Index Annuity with the optional enhanced death benefit. Choice Accumulation gives you all of the benefits of a typical FIA, including full protection from market-based losses. The EDB allows you the opportunity to more than double the money you plan to leave behind to your beneficiaries. For an additional annual cost, it guarantees 7% simple growth annually for up to 15 years on your leave behind money, or what we refer to as the death benefit, assuming you don't make any withdrawals. And it's an RMD-friendly strategy, meaning if you need to take required minimum distributions, the EDB is reduced on a dollar-for-dollar basis, which may lessen the effect these withdrawals have on your legacy. Let's look at how EDB works. Let's say you purchase Choice Accumulation Fixed Index Annuity with the EDB for $100,000 at age 70. To keep things simple, we're assuming 0% market growth of the contract value. The EDB is initially equal to your original premium and grows at a guaranteed 7% simple interest each year for up to 15 years, adjusted for any withdrawals. In this example, the EDB grows each year by $7,000, generating a value of $205,000 by the age of 85, more than doubling your death benefit. After you pass, your beneficiary gets either the EDB value or the contract value, whichever is greater. In this example, the EDB is greater, giving them over an additional $103,000. Now, at age 72, you may need to start taking required minimum distributions, or RMDs. And let's suppose you want to do this while leaving as much of a death benefit as possible in your IRA, which is funded by Choice Accumulation. So let's look at how the EDB can help with this scenario. This example again assumes you purchase the annuity at age 70 with an initial premium amount of $100,000, and there is no growth in the contract value. As you start taking RMDs at age 72, the death benefit is reduced by the amount of the RMD withdrawal, also known as dollar for dollar. However, the EDB's guaranteed 7% annual increase exceeds the RMD for several years, meaning your death benefit is growing even as you're withdrawing money. Ultimately, as RMDs continue, the death benefit value begins to decline. But the value the EDB has accumulated over the years may help to ensure it remains higher than your original premium. As a result, the total value of the strategy, combining the RMDs and death benefit, is well above the $100,000 initial premium. Assuming the legacy is passed on at age 85, this strategy produces over $179,000 in cumulative RMDs and death benefit. So if you have money you would like the opportunity to protect and grow, talk to your financial professional to learn more about how Choice Accumulation can help.
So again, that video is client approved. And I'm going to walk through a couple cases here in case that was too quick for anyone to illustrate, how each of those scenarios work. But again, that death benefit can be used in different scenarios. So we see it used just for straight non-qualified assets. For those clients that maybe are rolling over CDs or just going from one short-term annuity to the next. If you identify that those assets and ask the question, what are these assets for? A lot of times they're just looking to, most of all, protect it and grow it to pass it on to leave to a beneficiary, charity, church, grandkids, whomever. So this is a way to really do the same thing, but get 7% for 15 years in doing that. So with this case, this is just a non-qualified case where we're looking at $100,000 like the gentleman just walked through. I do want to point out that we're assuming the guaranteed values, which is saying that you really got unlucky. You didn't see $1 of interest credit while you were in this policy, which I think we can say that's probably not going to happen. But I do like to show that to show you the power that this optional enhanced death benefit provides. So really what you want to focus on is that far right column there. That's showing that that's 7%. So each year you can see the 107, the 114, that growing by 7% each year. So even though the portfolio, you got unlucky, we may have seen a huge bear market, you got $0 of interest credits on your contract value because you elected that optional enhanced death benefit feature. The death benefit is guaranteed to roll up at that 7% for those 15 years. And then you'll see that's at $205,000. That's the completion of that, after which that death benefit amount is locked in, assuming no withdrawals. Now, one question that I do get is, you don't have to hold this for 15 years to get that death benefit. The client were to pass out, 6 years into it, they would get the $142,000, whatever that amount is when the client passes away, that would be the death benefit at that time. So you don't have to get to that $205,000 number in this example, but you could get to that as it goes for 15 years. So this is a very similar scenario here, $100,000, but these are qualified assets. And I'm going to show with the RMDs coming out, just like the video did with I think the really cool bar charts that kind of show it in real time, but just walking through it. Same principle as far as the interest credits. We're assuming $0 of interest credits. You got unlucky again with these assets. But in this case, you'll see some more numbers here on the left showing the withdrawals, which is for the RMDs. So in this case, a 70-year-old client waited a couple years, started the RMDs. The term required is in the name. A lot of times it's required. The client doesn't want to do it. They have to. What they really want to do with these assets is grow it, pass it along, maximize it for their beneficiaries. They don't want to pull the money out and be taxed on it and have a lesser amount to pass on down the road. So that first column there, that's each year's withdrawals. This column here, we're showing those added up year on top of year, again, with those $0 of interest credits. If we look 15 years into it, just keeping with that example, we've taken out $57,000, just over $57,000 in RMDs. Put in $100,000, took out $57,000, and then if you track all the way to the right to that death benefit column again, our death benefit, it didn't go down by $57,000. It actually went up. $100,000. We now have a guaranteed death benefit of $120,000. Not only did it not go down because of the RMDs, it actually increased. What we're doing here is you're taking the money out to satisfy the RMDs, but you're still growing at that 7% figure. It's not a true 7%. The math is a little bit different, but again, the principle remains that you're growing your death benefit as you're taking RMDs. And the gentleman in the video mentioned the concept of a total value provided. All he did there was looked at the RMDs you took out and added it to the death benefit that you had. We've taken $100,000 in over 15 years. The total value between the RMDs and the death benefit is just about $180,000. That's the total value provided, and that's the power of the strategy, particularly when it comes to required minimum distributions. So I'm just going to end here. This is just a quick wrap up on that enhanced death benefit feature. I like it because it's quick. Again, 15 years, we can double your legacy. So whether you start with 100,000, grow it to 205, you start with 250,000, then the math is the same. Again, 15 years, 7%, 50 basis point cost. There are annuities that offer death benefit features out there. But I think when it comes to the combination of what Choice Accumulation 2's EDB offers, it's really unrivaled as far as the combination. The length of time that you get, the 15 years, you may see an 8, 9, or 10-year death benefit roll up. With the years, you may, 7, 8, 9, 10 years, or you may see, an 8% that only goes for 10 years. But the combination of us going 15 years and us giving 7% and the low cost that we have. And one additional feature that's not mentioned on here, but I don't want to gloss over because it is important, is that the beneficiary can take death benefit value as a lump sum. You'll also see some of these types of products, they make you stretch it out, whether it's over 5, 10 years or annuitize it. With us, you can do that, but you also can just take it all at once. So the beneficiary there is going to have a lot of flexibility how they want to receive the assets here. So with that, Scott, those are my prepared comments on the 150 plus, and more importantly, that EDB and choice accumulation too, that I know we've discussed in great detail, and I know that you're a fan of and talking about out there. So I'll pause there and be happy to take any questions on what we did address, or maybe anything else that people are wondering, what else Global Atlantic might have to offer. So Scott, I'll turn it over to you.
One thing I'd like to bring up, Chris, on non-qualified money. I've had this question a time or two. You guys allow 10% out right after it's issued. So within the first year, if somebody called and said, "Hey, I need to take some money out," they can get 10% out of the policy, penalty-free, and that's huge, because sometimes people don't think they need any money out of it, but something comes up, and they have to wait a year, or they have to wait longer to get that money out, and sometimes they can't get that money out at all. It's interest only, or whatever the case may be. So I like that you guys offer 10% right away if somebody does need to get some money out of there. And again, if you have the EDB on there, it's going down dollar for dollar, but it's a nice feature to have that, to be able to have that twist in there, that if something does come up, we can get some out.
Yeah, that's a great point. And honestly, Scott, it's something that maybe even I take for granted sometimes. It's the flashy and is the 7% and all the crediting, but just the flexibility there to be able to have liquidity with this up to 10%. I even see folks use this product. They don't, maybe just for whatever reason, don't feel they need an income rider, but they want to protect it, grow it, and at least replenish like an income that they're pulling out. So folks might set up a systematic distribution out of something like this, and allow either the death benefit or the interest credits, tied to the index you choose, replenish that, just to create an income stream off of this accumulation product. So that's a great point.
Another thing that's real nice about this too is it only takes $25,000 to get into this product, and also you mentioned the 50 basis points for the rider. That's probably one of the least expensive riders I've seen out there for anything. Most riders are 1% or more nowadays, and usually that's on income rider. But this is real nice, being a 0.5% and giving some growth of 7%. That's it's not going to fit everybody, but I think we have customers out there that we need to be looking at for money maybe they aren't using, or they want to leave legacy, or what about the guy that maybe just doesn't qualify for a long-term care or a life policy? There's no underwriting with the annuity. Obviously, we're going to have some suitability questions, but there's no health underwriting for annuities. So that's another reason I really like this product, and I think it's something that we should be looking at for that customer that we call and say, "Gosh, we just can't help you." Well, now we can. We can fire something up with some legacy to leave to the spouse or to the kids or whoever. So I think this is a product that it's going to take a little bit of thought, but I think there's a lot of unique opportunities out there for us to be able to use this product out there. I'm trying to see if we have any questions. No questions at this time. If anybody would like to ask any questions, you can raise your hand. I know sometimes you think of stuff after we've hung up. This is being recorded, so I will be sending it out to everybody that's on the call. And guys, feel free to give me a call if you have any questions. If you think of something, I will be following up with everybody that's on the call to get your thoughts on it and maybe talk about cases. Also, if you need an illustration, if you want to just see something for maybe one of your clients that, you haven't maybe talked to them yet, but you want to see what this would look like, just let me know and I can run you an illustration. It only takes a few minutes, very little information, just pretty much age, male or female, what state they're in, and how much you think we want to put in there. And again, this thing starts out at $25,000. So give me a shout. We can run you an illustration. We can talk about it. And we can also run it without the EDB rider on there if you have somebody that just wants an accumulation. I like the idea of the income product, and we'll be doing another webinar down the road here before too long, and we'll be going into more of these products. But if you have somebody that needs income, within that first year or two, this would be a great product to look at, to illustrate, and see if we couldn't help out with that. And the one other thing, if you weren't on Angie's call last week, well, I highly recommend if you do any long-term care, even if you just dabble in long-term care, Angie always does a wonderful job with the long-term care stuff, but I was on the call last week because I used to sell a lot of long-term care as an agent, and I pretty much refer back to Angie when I have a customer that needs that. But it's very, very interesting to see the different product avenues that it has, 2 and 3 times the contract. That stuff was very unique to me. So if you can make the call tomorrow, be at 10 o'clock tomorrow morning, just let us know if you need an invite to it, and we can get you registered. And it would be a good call for you to be on if you do any long-term care at all. And also don't forget to go to our website at Producers XL, and you can see the staff. You can look at Rick's Medicare stuff. He's always doing a Medicare University. Scott Gilpin in life, Angie in long-term care, and, of course, myself in annuities. And young Cody is working with the disability stuff now, too. So if you guys have a need for any of those products, feel free to give us a call here at Producers XL. I want to thank Darren and Chris for putting this on today. Always find something new and different, when you guys talk about this stuff. There's a lot of stuff to gather in here, but I always find out something a little bit different every time. I didn't realize $68 trillion. That's a unique number that's going to be moved around. So I think we have a good product here. I don't have any other carriers using this product with this idea behind it. So if you want something that's a little bit different, unique, that might fit that odd person, boy, 7% roll-up is really a nice legacy death benefit roll-up to grow on that also. I don't see any questions, guys. Unless you guys have anything to add, I think we'll wrap it up. And until the next time.
All right. Thank you, Scott. I appreciate it.
Yeah, thanks so much.
You bet. Thank you, guys. Everybody have a good day, and we'll be in touch. Bye now.